Surrey, dawn. An oak door, then a drill bit. A banker from the city stands in silence as bailiffs enter his house. The screens still glow red. The leverage is still there. The liquidity is not. Keynes said it with more courtesy than the market ever deserved. The market can remain irrational longer than you can remain solvent. Tonight, you will watch 10 Britons ignore that law and lose houses, contracts, pensions, even. It was all terribly respectable. Surrey stone, oak floors, a Range Rover on the drive, and a man from the city speaking softly about temporary dislocation. Alistair did not think he was gambling. He thought he was smarter than the cycle. Commercial property would recover. The Bank of England would blink, and his leverage would become genius. He borrowed at one point 5% and told himself time was on his side. That is how this class destroys itself in Britain. Not with vulgarity, but with spreadsheet arrogance. Every month, the interest carry looked survivable. Every quarter, the vacancies worsened. He called it patience. The market called it decay. One of them was using language, the other, mathematics. Then came the first small insult. Not a crash, not yet, merely silence. Refinance calls were not returned. Valuers became cautious. Credit committees developed standards again. In polite British finance, panic arrives as a delayed email. Alistair still hosted dinners, still nodded through claret and market gossip, while his debt stack began to rot underneath him. Quietly, elegantly, terminally. He had built his survival on one assumption, that the Bank of England would rescue men like him. But inflation was uglier than his model, so rates remained high and the commercial market stayed irrational longer than his balance sheet could remain solvent. This is the cruelty of macro shifts. They do not debate your thesis. They simply leave it there to. Then the fixed deals expired. It sounds administrative, almost harmless. In Britain, that is how a death sentence is often delivered. His 1.5% era ended, and the new variable rates arrived above 6. Monthly obligations did not rise, they detonated. Cash flow vanished. Liquidity was no longer a concept from the office. It was the difference between keeping. He sold the narrative before he sold the assets. Temporary illiquidity, mark-to-market distortion. Once the cycle turns, it was pure city theater. Diction used as anesthetic. Meanwhile, the villa had become collateral, not shelter. The lender notices thickened. The final demands arrived. The children learned to whisper. And behind that oak door, British success began to smell of mold, fear, and wet paper. The drill touched the oak at 6:12 in the morning. No shouting, no melodrama, just legal force applied with middle-class precision. Bailiff action is what happens when abstraction enters the hallway. Cars, electronics, artwork, furniture, reduced to recoverable line items. Alistair, who had spent years underwriting risk for others, watched strangers catalog his own life in pounds. The market had finished speaking. Afterwards, there was only the vulgarity of space. Empty rooms, dust where certainty had stood. He had waited for the market to become rational. Instead, it became patient. That is worse. And somewhere in Surrey, his solicitor Beatrice was still expecting invoices to be paid by the man who had just been liquidated in his own hallway. One collapse in Britain is never merely. Beatrice's life was arranged with legal neatness, cream walls, measured diction, invoices issued on time. Alistair was not merely a client, he was the client. 70% of the firm's dependable flow came through his world of property, refinance, and respectable distress. She thought proximity to wealth was safety. In Britain, that mistake has ruined entire counties. It feels like stability right until it isn't. She bought at the peak. Naturally, everyone called it prudent. A Surrey home was not speculation, they said, it was civilization. The price was obscene, the mortgage decorative, and the rate looked low enough to excuse any arithmetic. Beatrice did not imagine a trap. She imagined permanence. That is the genius of British property mythology. It dresses leverage in the language of virtue and calls it adulthood. Then the invoices lingered. First 30 days, then 60. She knew why before she admitted it. Alistair had not delayed payment. He had crossed into triage. When men like him stop paying, the contagion is already moving. Her staff still answered phones with practiced warmth. Salaries still went out. Yet the office atmosphere changed. Everyone became quieter because everyone had. House prices softened, then slipped, then refused to recover on schedule. Her mortgage remained. The valuation did not. Negative equity is such a civilized term, a bureaucratic phrase for captivity. She could not sell without crystallizing the wound. She could not move without admitting the lie, so she remained in place, paying for an asset that no longer. Once the firm lost Alistair, everything else became arithmetic. Lease, staff, software, insurance, tax. A law office is simply a liquidity machine wearing a moral costume. Beatrice cut discretionary spending first, then postponed decisions, then stared at payroll as though sheer professionalism might reduce it. It did not. In a downturn, competence is no shield. It simply lets you So she did what panic calls prudence. She pulled her angel capital from Colin's pub. Quickly, quietly, immediately. It was meant to save the house, to defend the little fortress of status still left to her. But rescue at this stage is merely harm transferred downstream. One frightened professional woman in Surrey yanks pounds from a London pub, and another life begins to fail. That is how domino. The property remained, the debt remained, the illusion did not. Beatrice walked through spotless rooms like a curator of her own mistake. She had obeyed the script, career, home, respectability, and still ended up in the housing prison. That is the cruelty behind British aspiration. The trap resembles success until the exit disappears. By then, the monthly payment is no longer housing. It is punishment. She did not hear Colin's pub go quiet that same week. She did not need to. Financial collapse rarely arrives as guilt. It arrives as continuation. Her wound had simply migrated. That is all markets do. Move pain between people with different accents and furniture. And in London, a publican named Colin was about to discover that one investor's private panic can turn off the heat in an entire building. Colin did not own a business. He owned a memory. Dark timber, old brass, Sunday roast, a pub that had survived recessions, fashions, and governments. That made him think it could survive this as well. British nostalgia is a dangerous collateral class. It convinces men that history is protection. It is not. The meter does not care how many stories the walls contain. It measures only energy and unpaid cost. Beatrice's capital had given him breathing room, a civilized little buffer against an uncivilized economy. With that money, he delayed repairs, covered wages, soothed suppliers, and pretended cash flow volatility was seasonal rather than structural. That is the trick of borrowed oxygen. It feels like recovery. In truth, it merely postpones the suffocation. By the time he understood that, the investor had already grown frightened. The call from Beatrice was brief, apologetic, and lethal. She needed her money back. There would be no debate because there could be no debate. Colin nodded into the phone with the dignity of men about to be ruined. Afterwards, he stood in the cellar among kegs and old stone and understood something ghastly. The pub was not collapsing because customers disappeared. It was collapsing because capital had become afraid. Then winter arrived with the delicacy of a mugging. Heating bills did not rise, they multiplied. The energy cap slaughter is what the British state calls the point at which local businesses are invited to die politely. 4 times the cost for the privilege of keeping the lights on in a room already half empty. Colin began choosing which parts of the building deserved heat. That is not management. That is rational. He called suppliers, lenders, the landlord, anyone still willing to use the word temporary. British decline has a tone of voice, apologetic, composed, almost courteous. Colin mastered it, but the figures did not soften out of sympathy. Pounds outpaced pints, overheads outpaced memory, and the old pub, once a symbol of neighborhood permanence, became what all failing businesses become in the end. The legal language arrived before the locks changed. Administration, enforcement, possession, such elegant words for a vulgar event. Colin had already taken 2 years prepaid rent from Dr. David for a private clinic plan in the upper floor. That money had vanished into triage long ago. Now the bank wanted the building, which meant one man's pub bankruptcy was about to become another man's professional. The final humiliation was elemental. He could not afford to heat the building. Then he could not afford to light it. A pub going dark in London winter is more than closure. It is public evidence that a community's margin has been erased. Colin locked up with fingers numb by cold and debt. Upstairs, Dr. David's clinic dream died as collateral damage in a building no longer under his control. By morning, the pub was an asset in recovery proceedings, not a place. Colin had lost more than a business. He had lost a story the market deemed non-essential. And somewhere else in London, Dr. David was about to learn that prepaid ambition is not protected from bank seizure. In this ecosystem, money never disappears gracefully. It is taken from one room. Dr. David had done everything Britain asked of a respectable professional. Study, service, endurance. The NHS title gave him status, but not enough freedom. So he tried the middle-class maneuver of the age, a private clinic, a little sovereignty, a little upside. He prepaid 2 years of rent to Colin and called it planning. In truth, he had advanced cash into a building already standing over a grave. When Colin's building fell to the bank, David's deposit did not become delayed. It became fiction. There was no clinic, no rooms, no return. Just a man of medicine discovering that his carefully saved capital had been swallowed by another person's insolvency. This is how systemic ruin travels, through contracts that look professional, prudent, even wise. One signature at the wrong moment, and years of effort evaporate. As if that were not enough, HMRC arrived in its usual invisible way. Thresholds stayed frozen, pay drifted nominally upward, inflation devoured the difference, and David was pulled into a higher tax band without feeling richer for a single day. The stealth tax rate is not dramatic. It is cleverer than drama. It empties purchasing power while preserving the illusion that your salary rose. That illusion does not pay. There is a particular humiliation reserved for upper middle Britain, earning well and still feeling poor. David discovered it in the supermarket aisle, the heating bill, the school costs, the quiet subtraction of comfort from daily life. He had not become reckless. He had become exposed. The system had raised his tax burden while reducing the worth of every pound that reached his account. That is not prosperity, it is erosion. Eleanor's digital agency had been building the software stack for his clinic, appointments, records, patient flow, the whole polished fantasy of efficient private medicine. David canceled it in one grim administrative sweep. He disliked doing it. That changes nothing. When liquidity disappears, morality becomes a premium product. He could no longer fund the project. So another professional ecosystem lost a contract because a building had died. That is the concealed joke of professional Britain. Titles remain, accounts do not. David was still doctor, still respectable, still impeccably spoken. Yet behind the nameplate sat a man who had lost a deposit, lost a venture, and been quietly taxed into fragility by HMRC. Status anxiety thrives in these rooms because the collapse is invisible until one payment fails. Then the whole costume becomes unbearably expensive to maintain. When the contract died, Eleanor's agency did what all agencies do under pressure. It sacrificed people before pride. David had not intended to ruin anyone. Again, that changes nothing. Macroeconomic cruelty does not require villains, only interdependence. A banker falls, a solicitor pulls funds, a pub goes dark, a doctor loses a clinic, a digital worker loses a salary. This is not coincidence. It is the architecture of modern British precarity. David returned to the NHS corridors with the same credentials and less belief. The private dream was gone, the deposit was gone, the extra tax remained. In Britain, ruin often preserves your formal identity while hollowing out your future. And in an agency office not far away, Eleanor was about to meet the more vulgar version of that truth when the email arrives, the salary ends, and the red letters begin. Eleanor belonged to that fragile modern tribe, digitally fluent, professionally polished, permanently exhausted. She sold efficiency to clients and stability to herself. The agency work was relentless, but the income looked clean enough to support a London life. David's clinic contract had been a pillar account. When it vanished, management did not use the word panic. They used the more British term restructure. It meant the same. It arrived in the usual way. Calendar invite, neutral subject line, too much HR presence, no raised voices, no cruelty technically, just a salary removed from the future. Eleanor listened with extraordinary British restraint while her internal arithmetic detonated: rent, food, transport, debt. She had thought the cost of living crisis was a background condition, a grim national weather report. It became personal the moment income stopped. Food inflation, energy bills, rail fares, everything rising with that uniquely British blend of bureaucracy and contempt. The cost of living crisis sounds like a headline. In Eleanor's flat, it became choreography. What to cancel, what to delay, what to pretend she could still afford. Poverty in the professional class begins aesthetically. You still look employed for a while. The decline hides itself inside subscriptions, groceries, and heating decisions. Then came the post, final notices, arrears warnings, the distinct red typography of institutional patience ending. Each envelope through the letterbox carried the same message in different fonts. Your previous life is no longer funded. Eleanor stopped opening some of them immediately. That is another British ritual of decline. Not denial exactly, but deferred humiliation. The letter exists, therefore the debt exists. Delay merely changes the lighting. Fiona's husband had already completed £30,000 of renovation work for Eleanor before the agency collapse reached its full temperature. That invoice now became another silent wound. Eleanor was not being malicious, she was being liquid, or rather, illiquid. That distinction matters enormously in finance, and not at all to the person who needed paying. One professional redundancy had just become a tradesman's unpaid. Savings were meant to buy time. They bought almost none. Rent still wanted its due. Bills still arrived on schedule. Hunger, unlike venture capital, does not wait for confidence to return. Eleanor began living in narrower and narrower dimensions, fewer meals out, fewer lights on, fewer lies available when friends asked how she was doing. Collapse had not yet become spectacular. It was still domestic, which is often worse. She could not pay Fiona's household what she owed. That became the private stain. Publicly, she was merely unemployed. Privately, she had become the reason another family's finances would start to split. Markets are marvelous at this, converting one person's hardship into another person's humiliation without ever naming a villain. Eleanor had become a node in a broader British sickness. For a while, Eleanor still dressed as though she belonged to the salaried class. That is the theater of British decline. Appearances retained long after the balance is gone. But behind the door, the letters were red, the fridge was meaner, and the debt was already traveling outward. Fiona would soon discover that when income stops in one household, enforcement begins in another. Fiona understood cash flow better than most. That, naturally, offered no protection whatsoever. Her husband's building work should have brought in £30,000 from Eleanor's project. Instead, it became a receivable, then a prayer. Small business Britain lives in that thin space between invoice and payment. Miss one and the whole machine coughs. Miss enough and the arithmetic professional becomes the next casualty of arithmetic itself. The indignity arrived first before the catastrophe, a prepayment gas meter. Feed it before it warms you. It is a beautifully cruel device, a machine that makes poverty tactile. Fiona, who balanced ledgers for other people, now watched her own heat become conditional on top-ups. British decline loves these little rituals of humiliation. They are efficient. They train the middle class to feel. Then the council tax slipped. Not because she forgot, because liquidity triages dignity. Pay food first, heat if possible, delay the council, hope for mercy. There is none. Fiona knew exactly what arrears meant because she had reconciled enough ledgers to understand the progression. Reminder, summons, liability order, enforcement. Knowledge can be very cruel when the disaster is your own. You see each step coming and still cannot stop it. The knock was ugly because it was familiar. Private debt collectors operate with a tone halfway between bureaucracy and invasion. Fiona heard it and understood instantly that the line had been crossed. This was no longer budget stress. It was physical recovery, television, car, anything with resale value. That is the special obscenity of late-stage debt in Britain. They made lists, not of debts, of objects. That is what breaks people. Fiona had spent a life accounting for value in abstract columns. Now value was being assigned to the sofa, the car, the television, the ordinary instruments of family life. Her husband stared at the floor. She stared at the forms. Somewhere in the background, unpaid work from Eleanor had completed its transformation. Her father-in-law George, decent and retired and still faintly trusting of institutions, pulled half his pension to save them. It was an act of love, which is to say, in financial systems, an act of exposure. Fiona accepted with gratitude and terror because she knew rescue this late merely changes who gets wounded next. Yet families always do it. We pass loss through blood when markets have exhausted contracts. The collectors retreated for a while. The meter took another top-up. The house remained theirs on paper. British people call this getting through it. More honestly, it is a pause purchased with someone else's future. George had stabilized the household, yes. He had also exposed his own retirement to the next macro lurch. Fiona knew it. George did not fully. That asymmetry is how family collapse continues. Fiona kept her home a little longer. That is all. The unpaid invoice, the prepayment meter, the threatened seizure, none of it truly vanished. It merely widened into George's retirement. And soon Harriet, his granddaughter, would learn that monthly support from family is only secure until the bond market decides otherwise. British collapse is hereditary in this way. It moves through kinship with dreadful efficiency. George belonged to the generation that still believed government paper meant safety. Work hard, save steadily, buy gilts, hold a pension, keep the heating on in December. It was modest, civilized, almost antique. He had already sacrificed half that pension for Fiona's household. What remained was meant to preserve his own old age. Then the gilt market meltdown arrived and informed him quite coldly that prudence is not immunity. Government bonds falling should sound impossible to men like George. That was precisely the horror. When gilts cracked, pensions wobbled, and the supposedly boring instruments of retirement became carriers of panic. Financial television called it volatility. For retirees, it felt more intimate. The floor itself turning liquid. George watched figures vanish from statements tied to decades of restraint. He had not speculated, the system had speculated on his behalf. December came and George made the sort of choice no developed nation should force on its elderly: preserve capital or preserve warmth. He turned the heating lower, then off. The room did not become dramatic, it became British, quiet, layered, denial wrapped in blankets. That is how middle-class hardship often looks here. Not overt destitution, but a dignified old man sitting in a cold house because the market has revised retirement. Harriet had been receiving £800 a month from him to help carry her London flat. George ended it with the sorrowful restraint of a man who knows arithmetic has overruled affection. Support is a lovely concept until your pension fund becomes a casualty. He did not want to abandon her. He simply could not subsidize youth while old age was being repriced in real time. That was the real insult. Not that he lost money in some exotic scheme, but in the dull furniture of retirement. Gilts, pensions, prudence. The old social contract promised boring safety. The modern system delivered boring danger. George looked around his quiet house and understood that institutional trust, once broken, leaves no dramatic ruin to point at. Only colder rooms, smaller transfers, and a slowly shrinking future no one on television will mourn. Harriet received the message, and within minutes, her own monthly equations became impossible. That is how quickly the old and the young now contaminate each other financially. George had tried to save Fiona and had accidentally crippled Harriet. None of them were reckless in the vulgar sense. They were simply connected, and connection, under pressure, is another word for vulnerability. Family becomes a transmission mechanism when the state ceases to absorb shocks. George sat before an unlit fire in a home he technically still owned. This is what destruction looks like for the British middle class. Title deeds intact, comfort gone, ownership without ease, pension without peace, family without capacity to help. The house remained his. The warmth did not. Somewhere in London, Harriet's variable rate mortgage was preparing to double, and the inheritance of stability was about to become a negative. George had always imagined passing stability down. Instead, he passed a shortfall. That is perhaps the darkest revision of all. In Britain now, prudence no longer guarantees inheritance. It can barely preserve present tense. Harriet would soon learn the arithmetic George had learned too late. When macro shifts arrive, family help is not a foundation. It is a temporary brace beneath a falling structure. Harriet sold London property for a living, which meant she spent her days converting unaffordability into aspiration. Viewings, jargon, prime potential, strong long-term fundamentals. She believed enough of it to buy her own flat on a variable rate structure, using George's monthly support as a pressure valve. The people who sell bubbles are often the last to admit they're standing inside one. They call it career confidence. The market calls it immersion. George's £800 had not made her rich. It had made the numbers barely survivable. When that transfer stopped, the flat ceased being a foothold and became a trap. She recalculated 3 times as though different arithmetic might produce mercy. It did not. In a variable rate world, the margin between young professional homeowner and future insolvency case is often one relative finally running out of money. Then the rate moved, and with it, her monthly payment nearly doubled overnight. People say interest rates rise as though they float upward politely. They do not. For households like Harriet's, they strike. The direct debit date became a threat. The flat she once described to clients as a smart early move now looked like a long-form confession written in mortgage clauses and wishful thinking. There is a moment in every true debt trap when the mind leaves the month and leaps to the entire life. Harriet reached it before dawn. Total liabilities, future interest, servicing costs, all of it suddenly larger than anything she could plausibly earn without surrendering decades. That is the point of no return. The horrifying instant when debt stops being a bill and becomes a biography. She tried to sell. Of course she did. But buyers had become scarce, financing crueler, sentiment uglier. The housing market she once marketed now looked back at her with perfect indifference. Viewings thinned, offers fell through. Each week held the same insult. Not merely that the asset was worth less, but that liquidity itself had vanished. A flat can be valuable on paper and impossible to escape. So Harriet began pre-liquidating herself: jewelry, furniture, anything discretionary. Extreme asset trimming is what desperation looks like in stylish neighborhoods. Nothing about the flat changed outwardly except the absence of small luxuries. Yet inside, the psychology had shifted completely. She was no longer a broker. She was inventory. Her life was being dismantled in advance of the formal event. Markets always teach the lesson twice. At the office, the damage spread. Harriet's property company had financed itself badly and sold too much dream at too little margin. Ian's local fund was exposed to its junk debt. As the market froze, her employer lost liquidity, and she lost the final fiction that a professional ecosystem would absorb the blow. In Britain, property downturns are never contained inside brick. They seep into pensions, funds, and payroll. Harriet finally understood the obscenity of the thing. The flat was not wealth, it was a debt amplifier wrapped in brushed metal appliances and respectable London postcode vanity. George's support had ended because his pension was wounded. Her employer was wobbling. Ian's fund was about to choke on the bonds. The same market had trapped all of them in different dialects. That is what makes a system elegant and monstrous. Ian believed in yield because the age rewarded men who mistook desperation for sophistication. His fund loaded up on junk bonds tied to Harriet's property company and similar names, instruments paying more precisely because they were closer to death. He knew the risk, or rather, he knew the vocabulary. In finance, those are often confused. The structure looked elegant while rates were cheap and exits were open. Then both disappeared. When the housing market froze, the bonds did not merely cheapen, they stopped behaving like tradable securities and began acting like accusations. Bid-ask spreads widened into mockery. Buyers vanished, marks fell, redemptions loomed. A local fund can survive bad prices for a while. It cannot survive the disappearance of liquidity. Ian understood that, which made the next phase even crueler. He could see the trap and still remained inside it. He needed the Bank of England to cut, not for prosperity, merely for oxygen. That was the humiliation. All the intelligence, all the modeling, all the structural cleverness, and in the end, the strategy reduced itself to a prayer that central bankers might become generous. Ian was not running a fund anymore. He was waiting for rescue from a macro regime specifically designed to punish inflation and collateral damage. Then the bank held rates high to crush inflation, entirely rational at the macro level, entirely fatal at Ian's scale. That is the split-screen brutality of modern finance. What stabilizes the system can annihilate the participants. His road back vanished in an announcement tone. No cheap refinancing, no revived property bids, no relief rally. Just a fund full of impaired paper, a queue of anxious clients, and the dawning knowledge that time had run out. Ian's particular anguish was intellectual. He had done what the age rewarded, sought yield, accepted complexity, trusted that policy would not stay punitive forever. Yet, the system did stay punitive. It did not care that he was smart money. It cared only that inflation remained offensive. This is the part finance professionals rarely admit. Markets do not merely punish ignorance. They also punish brilliant men who were directionally right, one quarter too soon. Redemptions, covenant pressure, frozen bids, and legal liabilities converged until the fund itself began to gag. Liquidity management became theater. Ian used every phrase available to delay panic. Temporary suspension, orderly process, valuation review. It was all true enough to be useless. He was no longer managing assets. He was staging the decline. Soon the enforcement company hiring bankruptcy, once spoken aloud, simplified everything, not mercifully, merely efficiently. Ian's fund could not meet the pressures placed upon it. The junk debt stayed junk, the market stayed shut, the policy regime stayed hostile. Jack's enforcement company was brought in to recover assets and fees, but by then the rot was systemic. There was less value left than the machinery of recovery itself required. Even the scavengers were underfunded. Ian had believed collapse produced winners somewhere. Distressed buyers, liquid funds, enforcement firms, someone clever enough to feed on the carcass. But the damage was broader than that. Jack's company would soon learn that when defaults become system-wide, there is not enough commission left, even for the men who arrive after the funeral. Macro movement at full scale does not spare the hunters. It simply changes the order. Jack made a living from other people's worst mornings. He knew the drill bits, the notices, the legal posture, the tense little pauses before forced entry. In a harsher age, such men were feared. In this age, they are subcontracted. Ian's failed fund was meant to be another commission line. Recover assets, collect fees, move on. Jack believed that standing on the enforcement side of the door made him safer than. But Ian's bankruptcy had progressed too far. There were assets on paper, yes, yet too little recoverable value, too many competing claims, too much systemic rot. Jack's firm advanced effort against commission that never properly materialized. In debt enforcement, people imagine the collectors sit outside the crisis. They do not. They are merely downstream employees of it. Once enough recoveries came in thin or empty, Jack's own company began to fracture. Vehicles still ran, staff still took jobs, phones still rang. Yet underneath, the business model was starving. This is the final irony of mass default. The machinery built to monetize collapse also depends on functioning debtors. Strip enough value from the public and even the men paid to seize it lose their footing. Jack had his own oak door, his own monthly obligations, his own private belief that unpleasant work justified a stable life. When commissions shrank and payroll turned uncertain, the protective mythology of the job evaporated. He was not outside the crisis. He was merely dressed for it. Bills fell behind. Pressure accumulated. The market had reached the point where even those who served enforcement could no longer pay to avoid it. Jack recognized every stage because he had inflicted them on others. The reminder letters, the failed arrangements, the turn toward formal enforcement. That recognition did not bring control, it brought dread. Few experiences are more corrosive than watching your own downfall unfold in a sequence you know by heart. Expertise is no antidote when the system has already chosen your address. It simply lets you hear the footsteps earlier. Then the call came from another enforcement team. His case had moved beyond negotiation. Another set of men with another drill, another van, another laminated authority was now assigned to his house. Markets adore symmetry. The man who once stood outside other people's fear would now hear the same knock from the inside. No speech could soften it. No industry jargon could delay it. Only the date changed. The bit hit the oak and Jack did not move. He knew the sound too well. For years it had meant authority, process, collection. Now it meant something simpler, reversal. Another bailiff team forced entry into the home of a bailiff. You could not script a cleaner ending for the proverb. The market had remained irrational. The debt system had remained hungry. And even the collectors had run out of solvency. And there it is, the final lesson spoken in oak splinters and legal force. From banker to solicitor, pub owner to doctor, agency worker to accountant, pensioner to property broker, fund manager to bailiff, the same system moved through all of them with different accents and identical intent. Keynes was right. The market stayed irrational. They did not stay solvent. In the macro